AMD's data center business just grew 107%. But can AMD actually take meaningful AI GPU market share from NVIDIA? That is literally the high-stakes, multi-billion-dollar question we're breaking down in today's explainer. The whole competitive narrative, it's completely shifted. It's no longer just about whether AMD can sell an AI GPU, it's about how quickly they can step up and become a scaled, incredibly dependable second platform for the biggest tech giants on the planet. So let's dive right into the data. Section 1, Q2 Earnings and Growth Engine. This is the catalyst. So AMD recently reported their total Q2 revenue at $11.54 billion. That's a massive 50% jump year over year. But honestly, total revenue is really just scratching the surface. To actually understand why Wall Street is buzzing, we've got to look under the hood. When we do, we see that $6.7 billion of that total came purely from the data center segment. Think about that for a second. The data center now makes up roughly 58% of AMD's total quarterly revenue. It's officially become the financial center of gravity for the entire company. In this specific segment, it's expanding at an absolutely blistering pace, up 107% year over year. AMD's filings make it crystal clear this explosive growth was driven primarily by their EPYC server processors, alongside a really strong ramp-up of their Instinct MI350 series GPUs. To put that growth into perspective, we're talking about a leap from $3.2 billion to $6.7 billion in a single year. But here is the absolute game changer: profitability. Just a year ago, this segment posted a $155 million operating loss. Today, that has completely flipped to a $2.1 billion operating income. The actual quality of AMD's growth has fundamentally transformed. Section 2, the GPU market share battle. It's NVIDIA versus AMD. Now, a quick caveat up front, AMD doesn't publish exact standalone market share numbers for their data center GPUs, but third-party 2026 estimates paint a pretty clear picture. NVIDIA is still the Goliath, commanding roughly 75 to 80% of the AI accelerator market, while AMD is sitting in the mid-single digits. So why are investors still so bullish? Simple. AMD doesn't actually need to match NVIDIA's installed base overnight. The real massive opportunity here is compounding from a small base. In a market expanding this fast, clawing back just 1 or 2 percentage points translates directly into billions of dollars of incremental revenue. So how exactly is AMD fighting this battle? Look, NVIDIA's moat isn't just their silicon. It's an incredibly sticky full-stack ecosystem. Their CUDA software platform gives developers deep familiarity, creating huge switching costs. AMD's counterpunch relies on ROCm, their open-source software alternative. They're aiming to deliver highly competitive economics and really capitalize on a growing desire among major hyperscalers to, diversify their suppliers. Make no mistake, AMD is competing against an entire platform here, not just a single chip. Section 3, Product Roadmap and Helios Architecture. AMD's strategic shift. AMD is bridging the gap by aggressively moving up the value chain. Right now, the engine is the MI350 family ramp, but the next, and frankly the most critical strategic step, is shifting away from just selling individual accelerator cards. They're moving toward delivering massive, complete infrastructure. We're talking the MI400 and MI450 series, all culminating in their future Helios rack scale deployments. Let's break down what Helios actually means for the market. This is a complete rack scale architecture built entirely on open standards. It seamlessly integrates AMD's Instinct GPUs, their EPYC CPUs, and Pensando networking, all into one package. The current reference design packs in 72 MI45X GPUs, pushing a claimed 1.4 exaflops of FP8 compute. In plain English, that is massive, highly efficient AI processing power scaled for the heaviest workloads. And this matters because the economic battle in AI is rapidly shifting toward inference efficiency, networking, and raw deployment speed. Section 4, Hyperscaler Deals and Revenue Reality, the proof. And the proof is really in the partnerships. The validation for AMD's roadmap is staggering. We've got a multi-year agreement with OpenAI for up to 6 gigawatts of GPUs. Meta announced a 6-gigawatt agreement slated to start deployment in the second half of 2026. Anthropic committed to up to 2 gigawatts of MI450 GPUs inside those Helios racks. And Microsoft is actively integrating Helios racks into Azure for frontier model inference. These are literally the biggest players in the world validating AMD for recurring massive scale demand. But as an investor, you have to keep this crucial distinction in mind. Announced gigawatts do not automatically equal recognized revenue. An agreement for capacity is just an execution milestone.
The actual cash? That only hits the books after production qualification, customer acceptance, and real-world utilization. The second half of 2026 is an execution window, not a guaranteed payday. If you find this AMD stock breakdown useful, subscribe to Fox of Wall Street, like this video, and share it with another investor who follows AI stocks.
Section 5. Valuation, catalysts, and risks. The reality check. Let's talk price. On August 26, 2026, AMD closed at $480.93. At this specific level, Wall Street has already baked in some pretty substantial expectations for continued aggressive data center growth. Between the massive earnings beat and these hyperscaler announcements, the bullish narrative is incredibly strong right now. But we definitely need some perspective here. The stock currently sits roughly 18% below its 2026 peak of $584.73. And that gap brings up a valid concern. AMD's fundamentals could be solid, but if broader AI growth expectations start to cool off, this stock remains highly vulnerable to multiple compression. Which brings us right to the central debate on Wall Street: valuation versus execution. The bull case is clear: sustained hyperscaler deployments, the software gap narrowing as ROCm adoption climbs, and fatter margins from a better product mix. But the bear case is just as real. It warns that NVIDIA's massive ecosystem dominance will keep AMD's economic share relatively small. It warns that supply chain or deployment delays could completely stall momentum, and that AMD's premium valuation could easily compress before earnings have a chance to catch up. Section 6. Key metrics for AMD investors. The forward look. Moving forward, you'll want to keep a close eye on these 6 specific metrics. 1. Data center revenue growth. Does it stay hot enough to justify the premium? 2. The GPU-specific mix within that segment. 3. Concrete deployment milestones, especially when Meta and OpenAI transition from plans to actual production. 4. ROCm adoption and developer usage rates. 5. Gross margin expansion. Can they consistently turn AI revenue into free cash flow? And finally, number 6, closely monitor NVIDIA's competitive response both in pricing and their product cycles. So here is the real bottom line to take away from this explainer. AMD's strategic prize isn't necessarily dethroning NVIDIA. It doesn't have to be a zero-sum game. If AMD simply establishes itself as a durable, highly profitable, and scaled second platform for hyperscale AI infrastructure, that alone could create absolutely massive shareholder value. Building a huge earnings base is totally possible, even if NVIDIA retains the majority share. This video is for informational and educational purposes only, and is not financial advice. Always conduct your own research before making investment decisions. So, looking at the data, will AMD become the cornerstone of your AI portfolio, or is NVIDIA's moat simply too deep to cross?